welcome back. Today we're covering options rundown training. We are going to be covering just the baseline basics of what options are. So let's just jump right into it. Again, I'm not a financial advisor. This is not financial advice. First off, what are options? It's the right to either purchase or sell 100 shares at a given price. The two types of options are calls. That's the right to purchase 100 shares at the strike price, and puts, the right to sell 100 shares at a strike price. So how does it work? The investors will pay a premium to buy a contract of either a call or a put. Each call or put will have an expiration date and a strike price that is selected by the investor or you. All right, so now we are looking at CHPT, and this is going to be under the call, buying a call option. This is supposed to expire on October 22nd. So it's either going to be under buy call or buy to open, and then you would select the call option or the put option depending on which one you are interested in. The price, you got the current share price of 1974 here, and then you also have the strike price. So if you are bullish towards a stock, you want to buy a call option, you would choose that $20 strike, and say you're totally sure that 1974 is definitely going to break that $20 by October 22nd. To break even, buying with the premium involved, you would have to have the strike price or the price of the stock be over $20.45 for you to start earning a profit. So over here, this is going to be the price of per share for the contract. So you have 45 cents per share. So overall, for 100 shares, each contract, that's going to be $45 in premium that you would have to pay to get involved in that contract. Um, we'll cover the Greeks real quick. So you have delta. Then that measures the change in option price when the asset price moves it. So basically, this is going to be for every dollar that the stock price increases or decreases is going to be the amount of gain or loss that you'll see in your option. You have gamma. So as that price changes, the amount of your delta will change as well. So as it goes up, the delta may become larger or smaller, or if the price of the stock goes down, the amount of the delta will become higher or smaller. You also have Vega. This is going to measure the change in option price due to volatility. So when the volatility moves, so the best time to buy options is going to be right after a dip when the stock price is stagnant or maybe trading sideways. And that's going to be the prime time to buy. You do not want to buy when the stock is already going up because it's just going to affect your premium and how much you have to pay and overall affect your profitability. Then you also have theta. So this is going to be the decay in option price every single day as expiration gets nearer. So we will take a look closer at that when we get to the next little bit here. IV crush. So you hear the word IV crush being thrown around a lot. Even the guy at Taco Bell, was talking about IV crush the other day. So IV crush is the phenomenon where the extrinsic value of an option contract makes a sharp decline following the occurrence of significant corporate events such as earnings. So unfortunately, this implied volatility crush catches many options traders or beginners off guard. Buyers of stock options before earnings release is the most common way options trading beginners are introduced to volatility crush. So again, based off of what I was saying earlier, buying in the hype, it's going to be overall bad for your options contract. You kind of want the stock price to be not as volatile when you're buying those. So you generally, if you're buying options contracts due to a catalyst, like maybe earnings is coming up, you want to probably buy it a week or two before that volatility starts to increase. So you selling options, you can also sell option contracts yourself. So it's probably the best way to get the stock price for the cheapest price possible, even under what this ticker symbol says. So covered calls, you must own 100 shares of the underlying stock to collect a premium. If the price is higher than the strike, you will sell your shares for that strike price at expiration. You also have covered puts. So you must own 100 shares of the underlying stock to collect the premium. If the price is lower than the strike price, you will buy the shares at that strike price at expiration. So you can also just sell calls that are backed by cash or sell puts that are backed by cash. Um, and basically, if you are super bullish towards the stock, but maybe it's having um, it's a down cycle, you would want to maybe sell those puts that you are backing with cash, and then that will let you buy in if it hits that strike price at a cheaper price than whatever the ticker symbol is. All right, so now I have CHPT pulled up. We're going to be taking a look at the different options here. So right now we are under the buy call option or buy to open call. So right now the share price is 24.09. The stock price took a significant increase since the last time we looked at it. If you are bullish towards the stock and you believe that the stock is going to be above the $25, you would be buying a call contract that would expire. Right now I have the November 5th expiration date. And to break even, the stock price would have to go over 25.71. And you would be paying 71 cents per share or $71 per contract to be able to have those available to you. Same thing with puts. It's just going to be the opposite. You're going to be looking for strike prices below the current share price. Um, so you you would just want the share, or say we wanted to buy a $24 put. We would need the stock price to be below 23.02 for us to start to earn a profit. We'll go over to sell calls. So this is going to be the sell to open option on other brokerages. So same thing, it's the same concept, except now you're selling the contracts yourself. So you can sell a call contract. Say we wanted, you're bullish on the stock and you want to sell, um, make that premium and maybe get your shares for cheaper. You can sell contracts that are further out of the money, and as you go further away from what the current share price is, the prices of the option gets cheaper. So in order to keep your shares, um, you would want to go one or two strike prices out, just to ensure that you're not selling your shares. Or if you're okay with selling your shares, pick a price that you are okay with selling at. So right now I have the $26 strike pulled up, and we'll take a look at the little information that it has here. So this is going to be what the cheapest price that the option is going for versus the most expensive at the moment. It shows you what it was at close on the previous day, the lowest price for that option contract, and the highest price for that option contract. It also shows you open interest. So this is the people that are trading these option contracts right now. And then we have the Greeks that we looked at before. So for every single dollar that the option or the stock price increases, you're going to see $27 added onto your option contract. And then we'll take a look at the theta. So the theta is going to be the decay of the option contract every single day um, as the expiration gets closer. So for every single day, you're going to be losing $5 off of your options contract. So this is one that you want to pay attention to because this can burn a lot of contracts super quickly. So I would make sure that you keep an eye on whatever the theta is before you buy your contracts. Vega, this is going to be the implied volatility and how it affects the stock price or the option price. So right now, with the implied volatility, it would only make the price go up by 1 cent. So it's not too terrible. So it means that CHPT is currently kind of trading sideways for the day. So this would probably be a prime time to buy options contracts for it. And then same thing goes for puts. You can pick your strike price, how much the premium you would make off of it is if you wanted to sell. And this would be a sell to open put. And then whenever you want to sell, I always sell before the expiration. unless you are trying to get the shares off of selling your put option. I if you're buying calls and puts, I would always sell before the expiration. If you're selling, you're stuck with that until the expiration date. Um, if you believe that the price is going to stay above $24, it doesn't look like it right now, but say that you're confident that it won't, you could sell your put contract for $24 and make that $101 premium. Um, and then if it does hit that $24, you would be losing, um, or you would have to buy the shares at the $24, but you also get to keep the premium. So, and that wraps it up for options trading. So if you have any questions, make sure you reach out to me. Make sure you take a look at our Discord where we have 12 analysts, each with over an 80% win rate, our own free algo, and over 500 members. Again, this is not financial advice, and I'm not a financial advisor. And do your own due diligence. And good luck.